Hello everyone, I am Reena Catherine, Assistant Professor in Department of Commerce, working in Dr. S.N.S. Rajalakshmi College of Arts and Science. Today we are going to see about what are the key differences between direct and indirect taxes. Let's see that one by one. In first column, what are the features they have? Second column, direct tax. Then third column is indirect tax. In first column, first one, what is taxed? In direct tax, income, profit and assets on these items, so the tax is levied. In indirect tax, consumption of goods and services will be levied on tax. Second one is collection, collected directly from taxpayers in direct tax. In indirect tax, collected indirectly from consumers or business. Next one is taxpayer impact. In direct tax, based on ability to pay. In indirect tax, embedded in prices, impacts consumers always. Then fourth one is progressivity. In direct tax, generally progressive tax rates increases with income or wealth. In indirect tax, generally regressive, takes up a larger proportion of income for lower income individuals. Then fifth one, administration. In direct tax, often subject to exemptions, deductions and credits. In indirect tax, applied uniformly, fewer exceptions or deductions. Next one is tax rate. In direct tax, progressive tax rates higher for higher incomes. In indirect tax, flat or uniform tax rates, same for all taxpayers. Next one is economic effects. Can affect incentives to work, save and invest in direct tax. In indirect tax, can influence consumer behavior and market prices also. Next one is compliance. In direct tax, requires detailed reporting and record keeping. In indirect tax, relatively easier compliance, less paperwork. Next one is transparency. In direct tax, taxpayers knows exactly how much tax they pay. In indirect tax, tax burden hidden within product or services prices. Then last one is examples for direct tax, income tax, corporate tax and property tax. In indirect tax, sales tax, value added tax and excise duty. In simple words, direct taxes are levied directly on individuals or entities' income, profit, or assets. Example, income tax, corporate tax, and property tax. These taxes are typically based on the ability to pay, meaning they are proportional to one's income or wealth. Direct tax are collected directly from taxpayers by government authorities and often subject to various exemptions, deductions, and credits. They are considered progressive because the tax rate generally increases as income or wealth increases, aiming to distribute wealth and promote social equity. Whereas in indirect tax, on the other hand, are imposed on the consumption of goods and services rather than directly on income or wealth. Example, sales tax, value added tax, excess duty, customs duty and tariffs. These taxes are embedded in the price of goods and services and are collected by intermediaries such as retailers or manufacturers, who then remit the tax revenue to the government. These taxes are regressive in nature, meaning they take up a larger proportion of income for lower income individuals compared to higher income individuals. However, they often have a broader base, applying to a wide range of goods and services. In conclusion, the main difference between direct tax and indirect tax lies on what is being taxed and how they are collected. Direct tax target income, profits or assets and are collected directly from the individuals or entities based on their ability to pay, while indirect tax are imposed on the consumption of goods and services and are collected indirectly through transactions. Both forms of transactions taxations play important roles in government finance and economic policy, with direct tax often used for redistribution and social welfare purpose, while indirect tax primarily serve as a revenue generators for government expenditure. Thank you.